I want to have a discussion about maintaining success over the long term. To be honest, almost anyone can have a short period of success in the market, but real market pros can keep doing it again and again for years. In order to improve and obtain long-term success, you need written rules to your system. This is why you have your strategy development document. And with this document, you can continually refine your process and become a better investor. However, you're also going to need statistics to review. So what stats should you keep? Well, I provided a simple Excel sheet, and that's what I keep track of from trade to trade. Now, it's not a ton of information, but whatever you decide to keep, whether it's what I provided or something in addition to that, I recommend that it's simple enough that you do it consistently among all of your trades. It's not going to help you if you only do it for some and not for others. I recommend that you track your buy and sell prices and the dates that it took place on, your reasons for buying and selling, what the percentage return was for your trade, and what percentage return that would have been for a full position. It's always best to review your biggest mistakes and your losing streaks. And these stats can be calculated from brokerage statements, but your thoughts can't be. So that's why you really want to put as much information as you can to describe your actions. Every time you bought a stock, what was the pattern? What was the reasoning? What were you thinking? These are really the key variables you want to keep track of, so you can go back and you can piece together what you were thinking. Sometimes you're so overwhelmed in the chaos of the marketplace that if you don't write down all the reasons for your actions, you're just not going to remember them later on when you go back to review. You also want to review your trades on a chart. Plot your buy and sell signals and try and figure out what are your common errors. This is how I developed the 3 EMA hold rule. I noticed I was buying stock, selling too quickly on any little minor reaction only to see the stock advance later, and I was able to develop that rule to keep that error in check. You want to make rules to fix your errors, but don't forget, every time you adapt your strategy to overcome failure, make sure it doesn't violate your risk management or your ability to hold major winners. Those are the 2 critical errors that any adjustment to your strategy can't make. Always take your ideas and review it against past winners to make sure that those critical rules aren't violated. And this is why it's so important to avoid strategy drift. You want to keep refining and you want to keep improving. And this is really what the best do. Take a look at Ray Dalio's principles for learning from mistakes, which is included in your notes. And this is a key element to how he always improves himself and has become a success over time. I also want to discuss my routine. So I trade for a living, and how I spend my time is likely different than how most people will. But I still think it's a good idea that I just give you an idea of how I approach the market day to day and throughout the week. So for myself, the 2 most important times a day are the open and the close, especially the opening hour. The opening is the most volatile time of day with the widest spreads. That's the difference between the bid and the offer. And this is when the majority of quick losses occur, but it's also when entries into the day's biggest winners also happen. Stops are difficult to use because the bid-ask spreads are so wide the first hour of the day. And that's why that period is really sacred to me. I won't take any calls, I won't chat with anybody. That first hour, I'm in the zone and I want to track everything that's moving throughout the marketplace. Typically, economic numbers come out earlier in the morning and the market's adjusting, and overnight news from Europe and Asia is being factored in. And so it's really a period of time where you want to be extremely attentive to the market. I stay in front of the market all day, but after about 10:30, you can probably get by with stops. The morning volatility has passed, bid-offer spreads have tightened, and you're unlikely to get stopped out just as a result of those wide spreads or some initial morning volatility, which over time can be extremely costly as that churn in your account really does add up at the end of the year. It helps to have consistent scanning of daily volume movers, and I do this throughout the day. I always want to see what stocks are up or down on above average volume. But if you're not there all day, you can also do this in the evening, and it's really important to see what is moving in the marketplace and what are the common themes. So I always like to see what's moving on volume. I also use the midday to scan for new names, and I reserve a couple of hours on the weekend to study weekly charts of stocks in my watch list, as well as review my holdings. When I look over my holdings, I always want to review exposure levels. As well, I want to imagine scenarios that I might need to adapt to starting Monday morning. You want to look at your portfolio and you want to ask yourself, what if the market falls quickly? What am I going to sell first? How am I going to react? Or what if the market strengthens? Where can I add? What can I buy? The weekends are really great for calm reflection. And oftentimes during the week, even during the day, it's so difficult to do that because the market's constantly moving and you're just so concerned with watching and maintaining your positions that you don't really have that calmness of thought to really sit there, imagine scenarios, and really plan for dramatic changes in the marketplace. As you can see, this doesn't leave a lot of time for additional study. So if you really want to learn more and get ahead in the market, this will mean that the market's really going to have to become your main pastime and hobby. There's simply too much ado preparing for the market that if you want to keep improving yourself, it will take more of your free time. And I just spent years and years of every spare moment, whether it was nighttime, weekends, the market was really all I would do. I'd read books, I'd look over charts, I'd study past winners. It was really a constant effort. And even William O'Neill would say, it's the effort you put in from 5 to 9 at night that gets you ahead, not the 9 to 5 during the day. It's a hard business, and only the best have stellar returns. It's one of those businesses where most fail, but those who do well do fantastic. So you really want to put that effort to be in that group of winners in the marketplace. Also, investing can be a lonely business because it's really a battle between you and the market. So I think it helps to have a couple of people to share ideas with. Most successful traders I know do have at least a couple of people to bounce ideas off of. What's important is that the person you speak with either has a similar strategy or you respect their market opinion, but you have a strong enough confidence to stay true to your strategy, even if their opinion differs from yours. I'm lucky to have my dad to constantly speak with. He's the main reason I fell in love with the markets, and we've been through all the ups and downs over the years, and we can really dive deeply into ideas together. We've read the same books, we've done the same study, so we really come to the market with the same point of view, yet we can still challenge each other with different ideas and different thoughts of the market and respectfully agree or disagree with each other. I also chat regularly with a couple of market pros who do trade a different style, but sometimes that helps me because they bring up market subtleties that I had missed, something new in the market, maybe something going on in the bond market and the commodity markets, and it helps to keep me abreast of news and changes and situations in the market that maybe I wasn't paying attention to. But I think the main reason to have someone to talk to is that no one will understand your ups and downs in the market quite like a fellow trader. It's an emotional roller coaster like no other, and sometimes we just need someone to talk to when we're down, or keep our ego in check when we're up. And in regards to keeping our ego in check, I want to discuss one of the biggest factors that I've seen cause the downfall of successful traders, and it has nothing to do with the market. Rather, it has to do with a lifestyle. Trading's tough in the first place, and once you achieve success, the battle isn't over. You have taxes to pay, expenses to run your operation, and the inevitable future drawdown. The downfall I've seen of most successful traders resides in overspending after a winning streak. It's alluring, you made a ton of money, and you want to celebrate. Trust me, I've been there. It's great, and it's a lot of fun. But trends end, and drawdowns do kick in. And if you spend a chunk of your money on a sports car, you're in big trouble when that broker calls with a margin call. And so this is really the single biggest factor I've seen in pros being forced to stop trading full time and having to go back to a regular day job. And for myself, that was always my biggest fear. And I always protected myself and kept adequate capital in anticipation of that drawdown. I don't care how great you're doing, you're gonna lose, you're gonna make mistakes, so you have to price that in. And the worst thing happens is you pay your taxes, so your account takes a hit. Then you go on a spending spree to fancy restaurants and fancy cars. Next thing you know, your account is too low and now you're in trouble. And once your account is too low and you're in trouble, all the other emotional pitfalls come in. You get stressed, you get worried, and you're no longer thinking clearly. That emotional neutrality is out the window. With time, the profits are going to roll in and the money will be there to spend. But if you celebrate too soon, and eventually when a bad market hits you, you'll be at risk of having your dreams disappear. So whatever you make, always spend as if you made a lot less than you made. And over time, as your account grows, you'll have that comfort and you'll know how much to spend. But just do me a favor, don't go out and blow all of your profits as soon as you make it, because you want to be able to survive that next drawdown. And that really comes back to staying humble. Be persistent and consistent. Don't overspend. Stay true to your mission. Refine your strategy by studying your losses, and eventually major success will be yours. You have to keep at it, but anyone can do it if they put in the effort. So we're nearing the end of this course. In the next section, we're going to review how all of these tools and all of these methods come together to form a holistic system to drive major profits and keep that risk in check. So let's check it out.